This video will help you understand how an irrevocable life insurance trust works so you can decide if it's a good fit for your financial plan. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. It's very common that as our office is running estate value projections over time, that clients will either today or at some point in the future have an estate in excess of certain federal and state level exemptions, essentially just meaning that they're going to end up paying estate taxes at death. Depending on the structure of the estate, it might make a lot of sense to implement a life insurance vehicle to provide some additional flexibility and cash on hand to pay said estate taxes. And furthermore, depending on the type of the estate, it might make sense to own said life insurance vehicle inside of a particular irrevocable trust called an Irrevocable Life Insurance Trust, or ILIT. So in today's video, we'll break down how an ILIT functions, some pros and cons, and then things to be aware of if you're going to look into setting up one of these programs. So let's jump in. So if you find yourself with a current or forecasted estate above the federal and or state level exemptions, you're going to be on the hook to pay estate taxes. Now, of course, there's some strategies you can employ ahead of time to reduce your estate, thus reducing the impact of said estate taxes. But there's certain exemptions to be aware of if you want to know how susceptible your estate will be to said taxes. On the federal level, as of today, the estate tax exemption is roughly $14 million per person. And what that means is if you're a single individual, if your net worth is over $14 million, you might owe some federal estate taxes. Or if you're a couple and your net estate is over $28 million, you might be on the hook to pay some estate taxes as well. Now, moving forward into 2026, the best minds in finance are projecting that level to be reduced and cut in half to basically $7 million per person. So something to be aware of is even if today you're not over those exemption levels, if you forecast in the future being over those exemption levels, you might want to stay tuned. More impactful than the federal estate tax exemption, which impacts a number of folks, but not the majority of Americans, more impactful would be the state level exemptions that might exist in your state. For example, Washington state has a state level estate tax exemption of $2.2 million. That means if you die in Washington state, or you have property in Washington state when you die, worth over $2.2 million in net value, you're probably going to be on the hook to pay some Washington state estate taxes. On the federal level, that estate tax is somewhere in the ballpark of 18 to 40%. And on the state level, depends on your state, but in Washington state, that tax is somewhere in the ballpark of 10 to 20% on any assets above and beyond that exemption level. And yes, that does mean if you are in Washington state, for example, and you're above those federal thresholds, you get to pay both federal and state level estate taxes. I'll link below to a map of the United States that breaks down which states have which state-specific estate tax exemptions, if any. Some states don't even have a state level estate tax, so you might not have anything to worry about. Now, depending on the size of your estate, it may or may not make sense to worry about paying estate taxes. And then one more thing just to clarify, when you do owe estate taxes, I keep saying you, but in reality, you'll be dead, so you won't be paying these estate taxes, but your estate will be liable to pay said estate taxes before beneficiaries can receive their assets. Now, the simple math would say, if you are above a particular exemption and you end up owing estate taxes, well, by definition, you have enough assets to pay the estate taxes. In reality, however, even though your estate might exceed a particular exemption level, it may or may not make sense to use those assets to pay said estate taxes. And that's because maybe liquidating a particular asset for the purposes of paying estate taxes could do more long-term harm than good. And for those situations, it might make sense to implement a life insurance policy to create some additional cash and flexibility at death. There's three main demographics that I see would value the implementation of a permanent life insurance policy the most, whether it's owned in or outside of a trust. And those three demographics would be, first, those who have very illiquid estates. For illiquid estates, where let's say the majority of the estate is made up of property, farmland, unique assets, things like that, you'd have to do a very large asset sale to generate enough liquid cash to then pay the estate taxes. For example, let's say you have an estate worth $5 million where you have two properties that are both worth $2.5 million. You don't want to have to sell one $2.5 million piece of property just to maybe pay 100 or 200 grand in Washington state estate taxes. Add a zero for a federal level example, but I think you get my point. A lot of times it doesn't make sense to liquidate rather large assets if the estate tax liability isn't equally massive. Even if it did make sense to sell an asset, oftentimes within the first 9 months after somebody passes away, that might not be the most opportune time to sell that asset. maybe we're in a depression, maybe whatever the particular asset is at a fairly depressed valuation, and it would benefit the owner to wait a little bit longer for that money to appreciate again. Either way, we don't want to be forced into like a fire sale just to generate cash. For those estates, it might make a ton of sense to have a huge influx of life insurance to then pay said estate taxes. Another demographic of estates where it could make sense to have a huge influx of life insurance come in would be for those estates that are fairly hard to equitably divide. Let's say, for example, the entire estate is made up of one closely held family business, and generation 1 is passing away and generation 2 is looking to inherit the business and run it. However, of the 3 kiddos that are next in line to inherit that business, only 2 of which are really interested in running the operation. One of which might do missionary work or travel abroad or whatever, but really doesn't have any interest in running the business. Well, it wouldn't make a ton of sense to have the inheritors of that closely held family business be 1/3, 1/3, 1/3, because odds are 2 of those beneficiaries would be doing all the work, and one of them would either just be benefit from the income or potentially make problems in the business. For those types of estates, it might make a ton of sense to have a huge influx of life insurance to where you can equitably divide the estate and split it up 1/3, 1/3, 1/3, but equitably by way of assets that are valued by the inheritors. Maybe the 2 beneficiaries who really want to run the business would do well to inherit the business 50-50, and the 3rd beneficiary who really wouldn't value running the business might be better served by having a large chunk of life insurance, right? No one's really going to say no to a huge bunch of cash, especially if it's equitably defined in the familial conversations and it seems all fair. The last demographic of folks that would probably benefit a lot from a huge influx of life insurance cash are for those who have very pre-tax estates. And for example, this could be very illiquid estates plus those that are hard to divide, but whereby the ability to pay said estate taxes would entirely need to come out of a pre-tax IRA. It might be easier to have a large influx of life insurance, pay said estate taxes, rather than liquidating a pre-tax retirement account and paying 37% plus in income taxes to do so, where it might make more sense just to have that IRA, for example, be split up into inherited IRAs for the next generation that most likely would end up paying income taxes at a lower income tax rate than the decedent. In those cases, having life insurance come through so that the decedent doesn't need to liquidate the IRA to pay the estate taxes, that could make a ton of sense. So it's not hard to see how, even in more situations than that, a large influx of life insurance cash at death could be very helpful in mitigating the impact of estate taxes on the estate. Where it's not helpful, however, is if the decedent owned that life insurance policy, then the death benefit gets added to the net worth of the estate, thus causing more estate taxes. So sort of like an Ouroboros, that's a snake eating its own tail, for example, any life insurance proceeds that get added to the estate then add to the estate tax liability. So we want to come up with a way where the death benefit from the life insurance can be used to pay the estate taxes, but the death benefit is not considered part of the estate. Thus ensues the Irrevocable Life Insurance Trust, or ILIT. Assets held within a properly drafted and run irrevocable trust are not factored into the estate of the decedent when the decedent passes away. So we simply need to have this Irrevocable Life Insurance Trust own and operate the life insurance policy. Essentially, we don't want that death benefit dragged back into the gross estate of the decedent when the decedent passes. Now, one common misconception about an irrevocable life insurance trust is that it decreases estate taxes. That's kind of true, kind of not true. So the Irrevocable Life Insurance Trust on its own does not decrease the impact of estate taxes. However, the most popular way of funding the Irrevocable Life Insurance Trust can decrease one's estate tax liability. And that's because funding the Irrevocable Life Insurance Trust is generally through the decedent, or soon-to-be decedent that we're discussing here, making annual gifts to the Irrevocable Life Insurance Trust for each beneficiary of the Irrevocable Life Insurance Trust. And that annual gift, which in 2024, the annual gift exclusion is 18 grand per beneficiary. You could give 18 grand per beneficiary per spouse every single year to the Irrevocable Life Insurance Trust, and you wouldn't impact your federal or Washington state estate tax exemption. Now, you don't have to give to the Irrevocable Life Insurance Trust to decrease one's estate. You could gift to them directly. You could gift to medical institutions, you could gift to education institutions, you could gift to charities, etc. All of that would reduce your estate. But when people say that ILITs reduce estate tax liabilities, this is what they're talking about. Because technically the death benefit doesn't reduce estate tax liabilities. It helps pay those estate tax liabilities, but it flat out doesn't decrease the number you'll owe either the federal or your state government. Generally, the way that funding an irrevocable life insurance trust works is you take the annual exclusion, which for 2024 is 18 grand, and both spouses gift up to that number to the trust for every single beneficiary that's involved in the trust. So at $18,000 a year each for both spouses, that's $36,000 a year per beneficiary. And if there's 5 beneficiaries involved in the trust, that's $180,000 a year they can gift without tax ramifications to the Irrevocable Life Insurance Trust. That trust then purchases a permanent life insurance policy on one or both of the future decedents we're talking about. And either they own those policies as single life permanent policies, or they own it as a joint or second to die permanent life insurance policy. And a second to die permanent life insurance policy is generally what we see out there for recommendations. And that's because that type of policy only pays out when the second insured passes away. AKA when both parents are gone, then the life insurance policy pays out. And the people gifting to this Irrevocable Life Insurance Trust can gift that $180,000 every single year, and most likely would be on the hook to do so every year until they die. And at death, that permanent life insurance policy pays out into the trust and distributes either to the beneficiaries or stays in the trust, however it's been drafted. And at death, that death benefit of the permanent life insurance policy is usable by those beneficiaries of the Irrevocable Life Insurance Trust to pay the estate taxes for the decedent, thus creating all that liquidity that we really desired without any of the estate tax consequences that would have gone into the decedent owning and operating the life insurance policy themselves. Logistically, while a lot goes into actually doing this successfully, the high-level overview is step 1. You open the Irrevocable Life Insurance Trust and you name a trustee that's not yourself to run and operate this Irrevocable Life Insurance Trust. Step 2 is you transfer your gifts into the Irrevocable Life Insurance Trust. Now that cash transfer to the Irrevocable Life Insurance Trust is considered a present interest gift to said beneficiaries, and as such, those beneficiaries are entitled to cash out that gift that you're putting in the trust. However, you've most likely had a conversation with them and you're expecting them not to take the money out. And so the way that you get around gifting to a trust and letting the beneficiaries know that money's in there but hoping that they don't take it out is by the use of a crummy notice. And that's step 3, sending crummy notices. So a crummy notice, and we'll touch on more of this in a future video, but it's essentially a notice to beneficiaries that say, hey, I've put money in this trust for you. You're legally entitled to take the money out, but I'd really like you not to. And if they don't touch the money, you can use the gift that you made into the trust to do things like purchase life insurance. I think there's like a 30-day window to where the beneficiary is entitled to pull the money out, after which time you can then go pay life insurance premiums. And that gets you to step 4, which is pay life insurance premiums or go buy a permanent life insurance policy. Now, you're most likely going to be buying a very large permanent life insurance policy. In the previous example of gifting to 2 spouses to their 5 kiddos, that's $180,000 a year that they're putting into a permanent life insurance policy. For the life insurance minded folks out there, this would most likely be an all-base type policy. Generally, I've seen like universal life insurance chassis for these types of policies, but it's essentially a heavily death benefit oriented policy. Because we're not overly concerned about the cash value in a policy like this, we're mostly just concerned about what is the death benefit rate of return. There's another way to get life insurance inside this type of trust, and that's to gift a current permanent life insurance policy into an Irrevocable Life Insurance Trust. Now, a quick caveat for federal level estate tax liabilities. If you gift your life insurance policy to an Irrevocable Life Insurance Trust and then you die in the next 3 years or before 3 years has elapsed, then the federal government is going to drag that life insurance policy death benefit back into your gross estate for the purposes of estate tax calculations. If, however, you survive past those 3 years, then the death benefit will not be considered part of your gross estate. On the state level, at least for Washington State actually doesn't care if you gift all your assets and all your life insurance away the day before you die. they don't have a 3-year clawback, and I know this because I called them and asked them the question. So let's touch on some pros and cons. So the pros, obviously, is your annual gifting to any type of trust reduces your gross estate, and thus reduces the impact of estate taxes on your estate. In addition, gifting to an irrevocable life insurance trust that is done properly, of course, that's a caveat, then the policy death benefit is not considered part of your gross estate, and thus can still be used to pay estate taxes on behalf of the beneficiaries, but is not factored into your gross estate and thus doesn't cause more estate taxes. Using this type of structure helps very much reduce the impact of needing to fire sale some type of asset to generate cash to pay estate taxes. It can help with equitably distributing assets to the next generation if, like I said before, there's maybe disinterested beneficiaries. In addition, this can help the equity of the next generation by maybe helping a few beneficiaries inherit cash and other beneficiaries inherit certain assets, what have you. And lastly, it could totally make sense from a tax standpoint to avoid needing to have the decedent's estate use IRA money to pay estate taxes at a very high income tax rate, whereas you could instead use life insurance proceeds and have that pre-tax IRA get inherited by the beneficiaries who most likely would have a lower income tax rate. One of the biggest values though, and we'll touch on this later on, is that the growth of the permanent life insurance policy death benefit is not a taxable event, which means it sidesteps all those egregious trust tax rates, which we'll touch on at the end of the video. So the life insurance death benefit, which viewed as an investment, which legally it's not, grows without taxes and then is inherited by those beneficiaries estate tax free. So what are the downsides? Well, at the end of the day, there's a bunch of costs to set up and administer and ongoingly administer one of these irrevocable life insurance trusts. It's not free, or at least if you're going to do it successfully, you probably don't want to go the free route. Another big downside is once you start the policy and start funding the irrevocable life insurance trust, you're pretty much locked in. And that's because the person gifting the money into the irrevocable life insurance trust cannot change the terms of the trust. And that's because it's an irrevocable trust. When it's irrevocable, you cannot revoke the trust without all the beneficiaries agreeing to make changes. Now, of course, there's some circumstances where by like court order you can change the trust, but you can't just change the trust willy-nilly because you had a falling out with a kiddo or a grandkiddo or whatever. Another downside is a lot of Generation 1 likes to see Generation 2 or 3 benefit from their annual gifts in that year. So rather than saying, hey, I very much look forward to you benefiting from all this wealth when I'm long gone, a lot of times they like to see beneficiaries benefit from their hard work and their gifts and use it for the value of their wealth building currently while they're still alive. And by gifting irrevocably to a trust, you won't be able to see that happen, at least with those gifted assets. The next downside is a combination of two aforementioned downsides, which is we can't change the terms of the ILIT once we start it. And two, if we have a falling out with a loved one for whatever reason, we can't stop having the insurance policy exist without all the beneficiaries agreeing. So the only way that these ILITs are successful is if all the beneficiaries are on the same page, cash flow is super consistent, and we have no falling outs. And most likely that being the case long term until the day that we die is a little bit challenging to forecast, right? How can we forecast that cash flow won't change for the family? Because if we can no longer make annual gifts to these insurance trusts, will we have to redo some policy design work? Will the life insurance policy lapse and all of that money contributed be totally wasted? There's a lot of what ifs that could happen. And so generally these types of policies are only going to be pitched, or should only be pitched, to the uber wealthy that can afford quite a bit of financial disruption. And the last downside are tax laws and estate planning laws changing. So if the estate tax exemption goes up, well, now this irrevocable trust is kind of not that valuable. Now, it still removes the death benefit from the estate, but you're going through all this rigmarole of gifting, crummy notices, buying permanent life insurance policies, etc. And you might not even need to do that if the estate tax exemption goes up. Another downside is if the estate tax exemption goes down. And if the estate tax exemption goes down, compared to what it was when you were planning all this out, well, now you need to buy more life insurance, or at least know that this isn't going to totally wipe out your estate taxes. In addition, if the annual gift limit goes down, well, now you have to decrease how much you're putting into the irrevocable life insurance trust, which thus decreases how much life insurance you're able to purchase. On the contrary, if the annual gift tax exclusion goes up, which it normally has always done, then you will most likely be underfunding what you otherwise could be gifting to the Irrevocable Life Insurance Trust. And then maybe you need to start gifting more, which might hurt cash flow. And if that's the case, then I probably wouldn't recommend that. So lastly, because a number of clients have asked me to start doing this, what is my opinion on irrevocable life insurance trusts? Well, I think ethereally, it all sounds cool. And as a part of the Certified Financial Planner curriculum and the Accredited Estate Planner curriculum that we all study, if you're going to be an accredited estate planner, then yeah, I think it's good to know how these work. I think on Excel, these can look cool if you use a bunch of liberal assumptions, but in reality, I just don't see that ILITs are going to be that impactful for most taxpayers. And even the uber wealthy, I just don't see that it's going to be that valuable compared to alternatives. Mathematically, if you have the ability to gift $18,000 a year per spouse, per beneficiary, then we simply need to look at the internal rate of return of death benefit in an irrevocable life insurance trust versus the annual rate of return that we are expecting through using an irrevocable trust, but using any other type of vehicle that you could otherwise put those funds into. Said another way, is the rate of return on buying life insurance better than the expected rate of return on investing in, say, the stock market? Now, you don't want to look at just the gross rate of returns because in those situations, a well-diversified stock-oriented portfolio is most likely going to significantly outperform any sort of permanent life insurance death benefit rate of return. Of course, unless you die the day after buying the insurance policy. You can't just look at the gross rate of return, you also have to factor in taxes. And that's because irrevocable trusts have very high trust tax rates. And while yes, income generated by the trust, say you owned like a rental property inside of a trust, you could plan on paying 40% in taxes at the trust tax rates on that rental income. A well-diversified investment portfolio, if structured properly within a trust, really shouldn't be generating a ton of income. It should be generating capital gains, which is taxed at the highest level at 20%. Now, compared to life insurance death benefit, which accumulates tax-free, if you will, you have to essentially compare a well-diversified stock portfolio accumulating at 10% minus 20% in capital gains taxes, so net 8%, compared to the internal rate of return of death benefit inside of a permanent life insurance policy. Now, having done all this math way back in the day, I've never seen it where death benefit beats a 100% stock-oriented or stock market index portfolio, and that's including factoring in taxes. You'd have to assume your investment portfolio is heavily invested in bonds and paying a ton of income taxes on those bonds, or you have to assume your portfolio just grows at like 6% a year. Keep in mind, the internal rate of return of death benefit goes down every year longer that you live, because the best time to buy life insurance is the day before you die. You put in $1 and you have $100 million left over after you're dead. In reality, the insurance company knows when you're going to die with far more accuracy than you do. And so if you look at the life expectancy for those who can buy life insurance, it's not the average life expectancy out there, because life insurance companies don't insure the average person. They insure the healthier of all the average people, which means most likely you're going to live a lot longer than the average person if you qualify to buy life insurance. Which means if you run an internal rate of return on the death benefit for when you're expected to die, most likely you're going to live longer than that, which means your internal rate of return is going to be less than if you lived until life expectancy. So from a cost to action standpoint, I would analyze to see if this type of program would make a lot of sense. If, say, you're not comfortable investing in a very well-diversified index fund oriented investment portfolio, and instead you otherwise would only feel comfortable investing in things like bonds, well, buying permanent life insurance could make a lot of sense if that's how you want to fund an irrevocable trust. If so, speak to your financial planner, have them run some models, speak with some insurance professionals who can help run some different illustrations to really illustrate what things would look like long term. And then finally, consult with an estate planning professional who can help you draft one of these trusts successfully. This is absolutely not something you want to DIY. So hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day. We'll talk to you later. Bye.